Good morning, everybody. Welcome to the Flow Show. We start a new week, Monday, the 17th of February. Might be a bit of a quiet one because we've got a US holiday, so markets are shut over there. So we might be seeing some few quiet moves later on, but certainly got a few pairs on a few levels at the moment, which we'll discuss later on. K-Man is off today. He's got some personal bits and bobs to attend to. So he'll be back with us tomorrow. Right, let's get into it. Going to start with a bit of data going on over in Japan, and more good news. We've had GDP data out for Q4. I'll find it. There we go. Coming in at a healthy 0.7%. Sorry, yes, 0.7% quarter on quarter. They're beating expectations, 0.3%. Up from uply revised 0.4% as well year on year. Very healthy 2.8% growth, beating the 1% expected. Now, despite that number coming in the red, investment was a big part of that rise in GDP. As you see, up 0.5%. Was expected 1%, but that's still pretty good numbers anyway. As for the rest there, you can see all pretty good as well. Private consumption not up as much as they would like, but still a positive number. Was expected to drop back. So good news once again for Japan. They end the year on the right footing. That's got the market to this morning, as you can see, by dollar yen and some of the other yen pairs thinking about the potential for a sooner rate hike from the BOJ. Still looking maybe around the May time. For expectations there. Obviously, we've got the spring wages coming up very shortly, which could be the decider. There's already some rumours doing the round that it's going to be as good, if not better, as last year. We have to keep an eye on that. PM Ishiba is obviously back in Japan, and with a headline that doesn't sound like he's too happy. He says the US decision to block the Nippon Steel US Steel deal was unjust political interference. That's a fairly strong sounding comment, considering, as I say, he's just had a meeting with Trump and everything seemed to go fairly well at that meeting. So I don't know if he's coming back and just preaching to his own population, but he's decided to pick out the Nippon Steel thing as a point of angst for that. Over in the UK, some good news coming. Apparently, a quarter of UK employers and firms plan to cut jobs before the tax rises that are coming in at the beginning of the new fiscal year. This is to do with national insurance hikes and changes of allowances that the government put in place, the Chancellor put in place. That doesn't start really biting until, as I say, the new fiscal year, financial year. But it seems that firms are already looking to chop jobs, a quarter of firms. Employment not doing so great at the moment. So it's going to be something else negative for the government to deal with. BOE's Bailey popped up earlier. Going for a wander around Wales, said that the Q4 GDP numbers do not change the general story on the UK's economy. Still says we see a gradual disinflation going on. ECB's Panchetta says there's no need to hold back on rate cuts as the 2% price target is in sight and inflation risks are to the downside. I love it when we hear these blinkered one-sided views. Victory laps from ECB members. What could go wrong with that? You know it and I know it. Over to the data from last week. US retail sales, a bit of a stinker by all accounts. Headline numbers coming in down 0.9%, a lot of red across the board. Control group down 0.8%. Now, bad numbers on the face of it, but you've got to take the time of year into account. As I always say, in the November-December period, you've got to take those 2 months together as you're reading for retail sales. Is it a surprise to see a drop-off in sales in January? Not at all. We were talking about this on Face on Friday. because the US had good months, November and December. So all the spending done then, and just looks like people took their foot off the gas, nothing else to buy in January. If we get a stinky one in February, though, that might point to a different picture altogether. But I'm not going to jump to conclusions that the Fed are going to be hiking next week based on those numbers. Bad, yes. A trend, not yet. We also got import and export price data there. Import prices there or thereabouts, still coming in pretty healthy, though a little bit softer than expected on the month. Export prices, though, were a bit hotter, which again could be a bit of front running all this trade stuff, finished goods and whatnot getting out the door pretty quickly, potentially in an effort to avoid tariffs, or people just shipping in from the US as well before who knows what happens with all that sort of stuff. But anyway, a bit hot on the export prices. Margin wise, that's probably better news for US firms anyway, because they're achieving higher output prices than they're paying for goods coming in or materials coming in and that. So margin wise, looking okay there. We also got industrial production data later on as well, and it was okay. Industrial production up 0.5%, though manufacturing was down 0.1%. This is all January data as well. Capacity utilization, though, ticked up, which is fairly good news for everyone there. But overall data, a little bit meh, nothing to write home about for that one. Fed's Logan says the next couple of months of inflation data will be pretty important. Even if we get better data on inflation, we should be cautious on rates. If the labour market stays strong and better inflation data, then doesn't necessarily mean that the Fed can cut. We just had a story out this morning that OPEC Plus are going to consider delaying their restart of supply output that was touted for April. Obviously, with Mr. Trump's drill, sent prices low. We've seen oil prices coming down. They were hoping prices to stay up so they could start sticking a bit more into the market. Well, looks like that's getting booted to the curbside at the moment. But as we know, with OPEC, we'll get 1,000 of these before the decision coming up, and probably comments from each side of the scale there. But anyway, that's the early opening salvo from the sources pieces. US Treasury Secretary Bessent on Friday said that they are also going to be looking at non-tariff barriers and currency manipulation. This was talking obviously after Trump's reciprocal tariff stuff. He says, we will see how trading partners respond. If Trump needs to, he will implement tariffs. The Trump plan on the Ukraine would intertwine Ukraine's economy with the US. And speaking on possible new Russian sanctions, says it all depends on how Putin comes to the table. Now, on the potential peace talks and whatever, talks are going to be starting with Russia and US officials in Saudi Arabia tomorrow. So that's the next stage that we're going to be going through. So expect some headlines potentially coming out of that. Tomorrow, we apparently going to get an interview with Fox, from Fox, with Musk and Trump. So no doubt that's going to be have some headlines to come with it as well. The US Trade Department, the panel will be holding a hearing on the 19th, which is an annual event that these guys get on the trade guys. They're going to be reviewing and identifying countries that don't protect IP rights. I only flag it up as a potential for the diary just for the headline risk. You never know what's going to come out of these sort of things. So that's just something to watch on the 19th. Trump, he says auto tariffs will also be coming around April the 2nd. So we've got this deadline put in place for all these reciprocal tariffs and whatnot of April. It's pretty easy to see what he's doing now. He's coming in with the tariffs, but giving grace periods to get people around the table. The market's reacting initially, then it probably go to sleep until we get about a week before those deadlines. And if there's no deals, that's when you might see some more market action. I was talking about last week about the 75,000 odd people who have taken this redundancy deal. Government workers taking this Trump redundancy deal last week. It was up to 75,000. I warned that doesn't mean it's the end of the game. Just because no one else has taken this package doesn't mean that Musk and his Doge department aren't going to be looking to slash more jobs. Well, there's been reports that the IRS is preparing to sack thousands or dismiss thousands of employees next week. So that could be this week, depending on obviously when that story popped up. That's it really on the headline front. Not a lot else going on. So we can look at what's coming up this week on the data front. Not an overly busy week, but we do start picking up some of the PMI data coming in, housing market data from the US. As I said, US shut today, so NAFL coming out from the Yanks. Overnight, depending on where you live, we get the RBA announcement. Will they cut? Will they not? Market's expecting a cut of 25. They have had inflation going the right way. So there is reason for them to start cutting, but they haven't indicated thus far that they would cut. We've had no RBA talking heads giving us any heads up, so it's a bit of an open question. If it's a cut, is it the start, or is it just a one-off little dip toe in the water type cut? We'll have to wait and see. I still think there's a bit of a risk that they don't cut. Either way, that's the bigger price risk. Aussie will take off if they stay on hold, but we shall see what they do. Anyway, jobs data in the UK tomorrow as well. Still not really worth the paper it's written on, while the ONS take forever to try and fix their abacus. But the market's going to move on the data anyway. As I mentioned earlier, UK employment not looking the best at the moment, so be on guard potentially for some more stinky numbers there. Keep an eye on the wage data as well, because it may include bonuses paid over the end of the year, new year, and what not. German zoo survey. We'll see how crap things are or aren't in Germany in terms of sentiment amongst businesses. Then we get the Empire manufacturing data. So this is the first data for February. Now this is going to be pretty important. Well, all data that we're going to get for February is going to be pretty important because it's the first data we get post Trump's inauguration. So it might be we start to see some of the effects of Trump. Prior data, obviously, a lot of it not counted until or was counted before he took the hot seat. So no real reaction. We've obviously seen in some of the PMI surveys, respondents commenting on what may happen when Trump's in. Now we may start to get some indication of what has been happening since he's come in. Is our firm still looking positive? Are they seeing his early policy moves as negative, the tariffs and whatnot? So as I say, this data this week, and we get the Empire, we get the Philly Fed, and we get the PMI flashes, S&P PMI flashes coming out. So they're going to be important to see if there's any early reaction to Trump policies. And the big orange man might be watching it himself to see how firms are reacting to his policies, which could shape them moving forward. So bigger data than normal for some of these smaller numbers, particularly Empire and the Philly Fed. Moving on, what else we got? Yeah, we've got some housing data coming out as well. Price data from the US. Then on Wednesday, it's the RBNZ. Again, expected to cut by 50 basis points. But a lot of expectations, particularly among the banks, is that if they go a 50 this meeting, then they may indicate a pause after that because they will be getting pretty close to their neutral rate. Or closer to the neutral rate. anyway, so market looking at them to potentially start slowing down. I think maybe the only risk for this is that they decide to go 25 and then maybe look to do another 25 and just slow the pace of cuts rather than stop dead after a big 50. But yeah, we'll see what happens with that one. Wednesday, UK inflation numbers, CPI and PPI, expected to see a bit of a bounce back from the decent drops we got last month, which came with some one-off factors, pricing up airfares and some other wild stuff that they decided to pluck out the air for those numbers. So we saw inflation coming down, which got the market dovish for the BOE, which then saw a rate cut. Now we'll see whether that's all going to be reversed in this month's CPI numbers. Housing starts and permits in the US, FOMC minutes later on, which probably not going to be much of a muchness, because obviously we've heard a million times from all Fed members, but you never know, there might be an odd comment in there as to maybe I'd look for anything really hawkish, whether anyone's getting a bit twitchy over whether they should maybe look at the hike side of things rather than staying on the dovish side and on the pause at least. Aussie jobs comes out on Thursday. That'll be fairly important depending on what the RBA have said. So if the RBA have cut and they're confident of continuing to cut, strong numbers here might delay them a little bit. Jobs market's been doing okay over there thus far. As I said, the Philly Fed manufacturing coming out on Thursday as well, but not too much else coming out from the US side of things there. Japanese CPI coming out on Thursday night, but that's obviously the follow-on from the Tokyo numbers, but still be important. Anyway, Friday sees UK retail sales. They've been a bit shite of late. It'd be a surprise if they're not shite on Friday as well. Those will be January numbers coming out there. So don't be surprised if they're worse or bad as well. The surprise will be if they're pretty good. And then we've got public sector numbers as well, borrowing numbers, finance numbers. Those will be looked at closely in the UK, especially with this upcoming spring budget statement thing, and whether Chancellor Rees is going to have to break her promises already from the last budget and hike taxes, or squeeze us mere mortals for a few more pounds of flesh, bastards. Then, as mentioned, got the PMI flash numbers coming in from around the globe. They'll kick off in Australia, Asia, Japan, that sort of thing. And then we get the European numbers, UK, through to the US numbers later on. Friday, we also get Canadian retail sales. So we get to see also how Canada's been doing over there. Their sales haven't been nothing to write home about, let's put it that way. Then we get the existing home sale numbers and the Michigan survey. And those, I think that's the final number, if I recall. So we'll see whether that's a big jump in we've seen in inflation expectations in some of these surveys. So we'll see if that stays up there, or if we're going to see it pulling back a little bit. So that's the data we've got coming up. A few bits and pieces to keep our minds busy anyway, but no doubt we'll be looking at what headlines Mr. Trump and co decide to drop on us. Right, let's have a little look at what's going on in some of the prices. So just looking at Brent crude, you see that rally there, 60 odd cents, 50, 60 cents just on that OPEC headline, but we're staying pretty much where we were. Oil markets, they're not, where am I going? Still got a pretty bearish theme to them at the moment after these rallies. So even if OPEC halt the supply restart that they're looking at in April, I can't see this rallying massively anyway. Everyone's still waiting for Mr. Trump to start drilling. But you never know, if we get some decent manufacturing PMI data this week, we could find oil getting a little bit of support just on the demand side. But I wouldn't hold your breath on that one just yet. Dollar yen, that's been, we had this dip, as I said, overnight on that good data. The market getting expectant for the BOJ hiking. We're back through 152. We're holding under 152. We've got this support again down in this 150s. Just we've been here down before a few times. It's been a little bit support and resistance. The main level under here is down towards these lows, 150.90s, just because it comes ahead of this level here. And we've had two bottoms close together down here. So if we do break under this 150, we could be heading for a look back there. Bit of a tight range to sit in, 150, 152, given the volatility in this pair. So if you get a move either side, that's probably one that might have a bit of room to roam, but I wouldn't be looking for too much today, perhaps, given we're going to have much lower liquidity. Fermentas, sorry. CFTC data, all-time record for long positions. Is there risk for them to start closing longs before contract expiration on March? Yeah, of course. Or, you know, you're going to get stuff rolling over. I don't really look at the CFTC stuff or use it for positioning and how the cash market, the spot market's going to move. Futures are a different kettle of fish. So depending on what you're looking for, if you think that it's going to rally, or yen pairs are going to rally on the back of the futures market reducing and rolling over, then I'm not too sure. As I say, it's only a small percentage of in terms of size of what's going through the spot market, so they are a different beast altogether. But anyway, dollar yen, let's see if it can do anything today. If we are coming down here, the big level really for me is down towards this 50 fib, which is this area. We're obviously going to get some action around the 150 figure, but this is the area here. 149.20s, just these lows, 149s down to 148.80s. So that's going to be a big area for me if we get down there. We still look to be firmly in rally selling mode. That was a big strong rally last week though, nearly up to 155s, but down nearly as quickly. And I'll have a look at 10-year yields as well, even though they're closed today, because we did finish up Friday after this decent jump up. We're back below, so it's ignoring Fed stuff really, because some of this was obviously on the back of the strong CPI, strong PPI, and all that sort of stuff last week. But we're not, as I've been saying, the market can't really get any more undovish than it is at the moment. If you're trading rate futures, then you're messing around between, whether cuts are coming in June, July, September, December, whatever. But the overall market it's not looking at hikes just yet. If we do start to shift that way, then you're probably going to see a bigger reaction. But otherwise, the market's happy that the Fed's on pause and not going to do anything more than that. But this coming back below 4.5% on Friday, a pretty significant move anyway for the dollar. Just keeps the dollar on the back foot. That you can see in euro dollar, that dollar being on the back foot because we're up above the zone. We had a little mooch into the 105 area, couldn't hold it for long. We're back down below. We're just holding support above the top of this zone here. So staging a little bounce. Again, probably this one we'd probably see a bit of range, maybe 105s, 104.70s for the day. Just keep an eye though, if we do start breaking up through here and start getting above 105.30, then we could see a bit of an acceleration on. But as you can see, the top of this zone pretty solid, big old level. The 105, a big old level historically anyway. But as you can see, there are plenty of times when we get through 105, but can't get through 105.30. So another one to keep a close watch on. If we're busting down under here, I think you're probably going to find a decent bit of dip buying in this one at the moment. As I said, just because the mood is a bit bearish on the dollar, which means it's going to be a bit bullish in other pairs. But yeah, if you get a little funky move down here under this zone, maybe down to 104s, it's not coming or anything. It's looking like a low liquidity move. That just might be something to consider getting the dip on that one. That's something I'll be looking at anyway. One moment, good people. So I just need to take a little sip of water. Dollar CAD still keeping the breakdown going. We're holding below 142 at the moment. 141.90, 142 is the area just around here. So we're holding that, but another tight range going on here. We can't get through this 40-50 zone down below. So again, for today, could we break up? You know, we've knocked on the door a few times here. So it may be possible that we get a move up 142, 20, 30 just in this little traffic area. We might find further resistance. And again, unless we're headline driven, any moves up to here are likely to find a decent bit of selling. I may indeed look to add to my short, to my break short, if we get up and hold this level again. Don't see any reason why this break should suddenly reverse, but I'm not the market. You never know what happens. Could get a headline that sends us all the way back up there. So really, you're going to be led by whatever direction we move in. If we do get through this 141.40s, I think we see another fairly swift run like we did on this break. That'll take us down to at least 141, 140.90. A bit of an area down here. Got the 50 fib of that move down there as well, 141s. So yeah, I wouldn't be surprised. Break up, we're testing that zone. Break down, we're testing that zone down there. But we're not going to stay trapped in this range for too long. Euro sterling. As I said, we've got a bit of data risk for the UK this week. So if we're getting good numbers, then we could be seeing a move at least to 83s, maybe under 83s, to go and test down this zone down here. But if it's bad news, then we're probably going to be moving up towards 84s again. But this one's still ranging, not really looking like it wants to bust out anywhere. So yeah, probably just good to look at potentially trading the ranges here. I doubt we'll see anything up towards this high, near the high 84s, 85s, but we might get something up towards the 84s. So this is really the two zones that you can trade between if that's your kettle of fish. Cable, what's going on in cable? We can't quite get an hold above this 126.10 area. So it's proving a bit sticky. It doesn't look like it's pulling back too far, so it's keeping the pressure on, keeping the momentum going in this rally. But I think from here, you don't really want to be long at the top unless we're holding. We've broken above and we're holding 126, 126.10 as support. So if you get a dip, 125.5 is your likely candidate. We had the break, we had the hold, so technically it's doing the right thing there. Just keep an eye on that. Aussie dollar, let's get into the right one. That's keeping the move up above 63.30. Obviously, the RBA is going to be a big thing. If they do cut and the market's expecting it, I'm not expecting Aussie dollar to dip massively unless they do something surprising, like go a 50 and say they're going to go a 50 again. So it's going to take a real dovish cut, to get this one meaningfully lower. But if you get a little bit of an algo knee jerk just on a 25 cut and moving on, then you're likely to see the dips being bought, particularly anywhere down into this zone here. Otherwise, we might be heading towards a test of the 64. And 64.16 is the 38.2 fib of this move from the 69.50s, 40s, 50s. So that'll be the first real test of the trend. So we've spent since middle of December still in that downtrend, still happy to make new lows. So this is the first time we've really looked like we might want to test the trend. But if we hit there and we can't get through, then that might suggest this trend isn't finished just yet. But otherwise, I'd expect maybe a bit of sideways action to go on from here. Obviously, with both central banks, RBA and RBNZ, coming up this week, Aussie Kiwi is going to be an important currency, going to get some volatility in there. We had a good shift down on Friday back below 111, but we're now turning around this area again. So for me, I'm short. I'm still happy to stay short. I didn't add in this rally here. I might do if we get up here. Now, there's a potential for this to move around quite significantly. Obviously, if the RBA hold, that will go against what the market's expecting. Then I'd expect this to have a good rally. May even get up to these highs at a minimum, maybe even up to 112. So let's look a little bit wider. So you can see this is quite a significant level on its own, up at this 111.70s. If we do bust up, the next level isn't until sort of 112.85, which is a bit of a long-termer as well. And then we're getting into some real big range tops up in the 114s. I'm not expecting that over the RBA, but we could get up towards, as I say, towards that 112 area. I might think about an add to the short there, because I think even if they do pause this month, it's not going to be too long if the data keeps going, particularly inflation, where they do start indicating they're going to start cutting. The longer they leave it, the faster they'll probably then have to cut. Maybe even the bigger size they'll have to cut. So either way, I favour the short side. And that's even with the RBNZ. If they cut a 50, then go on pause, that's likely to be a little bit positive for the Kiwi. And that will mean also further out that the RBA will close the gap on that rate divergence if they have to enter a cutting phase as well. So for me, all signs still favour the short side in this one, and I'm going to stay that way unless the price kicks me out. Right, let's have a look what else you're talking about. Galaxy, huge uncertainty here. Investment has really slowed down due to uncertainty. Where's here? Are you talking the US or somewhere else? Possible false break in cable brand. Yeah, it is possible. But the fact we're holding up here, as just said, we haven't dipped too far back from here. And we're up knocking around this 126 again. So this, intraday false break or fake break, is the trend turning? No. These shallow dips suggest that we might still continue this move up higher. One thing to look at is stocks and S&P first. Now, as you know, you've all got different platforms. There's different futures, different CFDs, different this, different that, all showing slightly different pictures. Some are breaking to new highs, others are not. Like this one is showing new highs, this one's not showing new highs. This is the cash market, and this is where I think you've got to be looking and watching. Obviously, it's going to be closed today, but this isn't the sort of price action you want to see when you're breaking a decent level. We had a decent top up here, then we've had a break. It couldn't make any inroads, 20, 25 pips above, then the pullbacks, then we try again, can't do it, then we're holding the level again, then we're trying again, can't do it. Now, I'm not saying this is going to suddenly collapse or anything like that, but when I look for breaks, you want to see a price moving on. You want to see it breaking and then taking off again. The fact that we can't really do that is a bit concerning. So if you're long, and particularly if you're long up some of these higher levels, the high 60s, then you want to be a bit careful, because if we do fail here, we're going to get this type of pullback that we've seen. So something, you know, maybe under 6,000 again. And if it goes on long enough, then you might be looking at a steeper pullback, something, that sort of thing, magnitude. But just keep an eye. If you do get above here, 61, 20, 30, and it starts to hold, then that's your springboard. Obviously, if you start getting a hold here at 61 and it's looking decent, we haven't really managed to do that at all, then again, that gives it the impetus to kick on up. Obviously, we're not going to know about that until tomorrow when US cash markets open. But just be careful when you're trading your CFDs and your futures compared to what's happening in the cash market, because, you know, these can go and make new highs and whatever, but if the real market isn't going to follow that behind, it's going to keep the brakes on it. So just watch your differences there with those markets. I was looking at the FTSE last week. We've had a move down support again, a bit like gold, just building the levels up as they go. We just had a little bit of a move through this one, but we're back above. So this one might just be washing out around 87.30s. This one is really the one to keep an eye on any further dips, 86, 88, 90, because that's technically perfection. Hold, break, hold. Up here, still see if rallies hit trouble up towards that 87.90 area, and then obviously up towards the highs, but it's not pulling back too far from this, and it's been on a fairly strong rally since this break anyway. And particularly since the 8,000 level, very, very strong rally. Not looking like it's wanting to pull back at all just yet. All right, last one, gold, I think, and then we'll call that a day, since it's a Monday. I never like talking too much on a Monday. Again, similar picture. I had a couple of levels that I just drew on last week. You know, we had this resistance that came in after this move back down, and we just sort of mooched around it a bit. I'm going to keep it in there for now. We had another test late Friday down towards this 75, 80, whatever you want to call it. We've had previous resistance, previous support. We had that spike under, then we've had the hold today. It's bounced back up to this 29.08, which is a bit of a, you can call it sort of 07, 11, something like that. Around here, it's proving to be a bit of a pivot level. When we're below, we're holding. When we're above, we're holding. At the moment, we're holding below. Again, another tight range. So really, if we're breaking back below these lows, maybe we're heading a bit lower, maybe down towards 28, 58, 60, 55s, that sort of area. Above here, just keep an eye on that. It's only an intermediate level. But it might be that if we're back above this level and holding it, we're going to take another look at the highs. As you can see, what is pretty significant is that we marked a bit of a double top here. Okay, so again, if you're looking for where to pick the tops, imagine last week we were getting that one high. You didn't know what happened. Well, that was your signal to maybe look at shorts, getting up towards that prior high and not matching it or getting through it. That's your signal to try then picking tops if you so wish. Now, if we get another move up here pretty quickly, if this goes up pretty quickly, I'd be wary that we get a break, because I never like a price coming back. But if it does hold, you know, and I'm talking not even making a pip or two higher, if it does hold, then there's a possibility of seeing an even steeper pullback. There's two ways it can go. We either do something like this and then we see something like that, or a bullish looking signal will be we do something like that and then we start doing something like that, and then that would indicate we're potentially going for a break. Okay, so just watch the type of price action. There's risk both sides. Okay, there's one risk that we come back up, make a triple top, and then we see a steeper pullback, or we do this, can't get through, but then we just start seeing really, really shallow dips, and it's building, 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 and then we're going to be off to the races once again. Right, unless you guys and girls got anything in particular, get it up quickly, or else I'm going to call that a day for today, seeing as I'm with Todd. And then Galaxy, are you talking about the US? Retail sales likely dip more. Yeah, obviously this government spending, this government people getting tinned and sacked and whatever is going to affect things, and it will affect things like retail sales and whatnot. But we'll have to wait and see, Mr. Galaxy S22. Right, all done and dusted. Thank you very much, boys and girls. Don't forget to join us on Face later. Otherwise, I will see you all nice and early tomorrow. Have a great day, everyone.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.